If you were only allowed to watch one Forex trading video this year, this would be the one. Because by the end of this video, you'll understand what the Forex market actually is, how traders make money from price movements, and the foundation you need before learning smart money concepts. And if you stay until the end, you'll start seeing the market in a way most beginners never do. So if you're serious about learning Forex trading, make sure you subscribe to the channel, because this video is episode 1 of a complete Smart Money Concepts trading series, and each episode builds on the previous one. Forex simply means foreign exchange. It is the global market where currencies are bought and sold, and this market is massive. Every single day, more than $6.5 trillion is traded in the Forex market. Let that sink in for a moment. $6.5 trillion. That makes Forex the largest financial market in the world. Banks trade currencies. Governments trade currencies. Large financial institutions exchange currencies every second. And traders like you and me try to profit from the price movements between those currencies. But before you can understand how traders make money, you first need to understand something called currency pairs. What are currency pairs? Every country has its own currency. For example, the United States uses the US dollar. The United Kingdom uses the British pound. Japan uses the Japanese yen. Canada uses the Canadian dollar. Australia uses the Australian dollar. Whenever two currencies are exchanged, they form what is called a currency pair. For example, EURUSD. This represents the euro versus the US dollar. GBPUSD. This represents the British pound versus the US dollar. USDJPY. This represents the US dollar versus the Japanese yen. When you open a trading chart on platforms like TradingView or MetaTrader, you will see these currency pairs constantly moving up and down. That movement is where traders make money. If a trader believes price will rise, they place a buy trade. If they believe price will fall, they place a sell trade. And when the market moves in their favor, they profit from the difference in price. But here is something many beginners don't realize. The Forex market does not move the same way all day long. Forex trading sessions. The Forex market is open 24 hours a day, 5 days a week. It opens Sunday evening and continues running until Friday evening. However, the market moves differently depending on which part of the world is trading. There are 4 main trading sessions: the Sydney session, the Asian session, the London session, and the New York session. But the sessions that matter most for most traders are London and New York. Why? Because this is when most of the world's trading volume enters the market. And when the London and New York sessions overlap, volatility usually increases. Price moves faster, liquidity enters the market, and trading opportunities become much clearer. But before choosing what to trade, you need to understand that not all currency pairs behave the same way. Types of Forex pairs. Forex pairs are generally grouped into 3 categories. The first category is major pairs. Major pairs always include the US dollar, and they are the most traded pairs in the world. Examples include EURUSD, GBPUSD, USDJPY, USD-CAD, USD-CHF, AUD-USD, NZD-USD. Because these pairs have very high liquidity, they tend to have smaller spreads and smoother price movement. This is why most beginners should focus on major pairs first. The second category is minor pairs. These include major currencies, but they do not include the US dollar. Examples include EURO-GBP, EURO-JPY, GBP-JPY. These pairs can still offer good opportunities, but they sometimes have slightly wider spreads. The third category is exotic pairs. These combine a major currency with the currency of an emerging economy. Examples include USD-MXN, USD-ZAR. Exotic pairs often have larger spreads and unpredictable movements. Because of that, beginners usually avoid trading them. For now, focusing on major pairs is the best approach. Understanding price movement. Every currency pair contains two currencies. The first currency is called the base currency. The second currency is called the quote currency. Let's look at an example. EURUSD. Here, Euro is the base currency and USD is the quote currency. If EURUSD is trading at 1.1487, that means 1 euro equals 1.1487 US dollars. When that number changes, traders can profit from the movement. These movements are measured using something called pips. What is a pip? A pip is the standard unit used to measure price movement in Forex. For example, if EURUSD moves from 1.1487 to 1.1488, that movement equals 1 pip. If the market moves 10 points higher, that equals 10 pips. And these small movements happen thousands of times every day. But to actually trade those movements, you need a few basic tools. What you need to start trading. First, you need a phone or a computer with internet access. Second, you need a Forex broker. A broker is the company that connects you to the Forex market. They act as the middleman between traders and the global market. When you place a trade, the broker executes that trade for you. Brokers typically make money in two main ways. The first is the spread. The spread is the difference between the buy price and the sell price. The second way is commission. Some brokers charge a small fee when you open or close a trade. Another concept you'll hear often is lot size. Lot size. Lot size simply refers to the size of your trade. A standard lot equals 100,000 units. A mini lot equals 10,000 units. A micro lot equals 1,000 units. Most beginners should start with micro lots like 0.01. This keeps risk small while learning, because in trading, protecting your capital is more important than chasing fast profits. Understanding leverage. Another important concept is leverage. Leverage allows traders to control larger positions using a smaller amount of money. For example, with 1 to 100 leverage, a $1,000 account could control $100,000 worth of trading power. This can increase profits, but it can also increase losses, which is why risk management is one of the most important skills in trading, and we will cover that in detail later in this series. Demo trading. Before risking real money, every beginner should start with a demo account. A demo account uses virtual money, but the market conditions are exactly the same as the real market. This allows you to practice trading, test strategies, and learn how the market behaves without risking your own money. Once you become consistent on a demo account, you can move to a live trading account. Understanding candlestick charts. Most traders analyze the market using candlestick charts. Each candlestick shows how price moved during a specific period of time. That time period could be 1 minute, 5 minutes, an hour, or even a day. Each candlestick shows 4 important things: the opening price, the highest price, the lowest price, and the closing price. If the candle closes higher than it opened, it is called a bullish candle. This means buyers pushed the market higher. If the candle closes lower than it opened, it is called a bearish candle. This means sellers pushed the market lower. Candlesticks are essentially the language of the market. They show the battle between buyers and sellers. But here is something most beginner tutorials never explain: the truth about who moves the market. The Forex market is not random. Behind most major price movements are large financial institutions, central banks, commercial banks, hedge funds, large investment firms. These institutions control massive amounts of capital, and their activity moves the market. Retail traders do not move the market. Instead, we try to follow the footprints of institutional money. And learning how to identify those footprints is exactly what Smart Money Concepts teaches. What's coming next? In the next episode of this series, we're going to cover one of the most important foundations in trading, market structure. You'll learn how institutions actually move the market, why most retail traders lose money, and how to begin reading charts like professional traders. So if you want to learn how smart money really trades the Forex market, make sure you subscribe, because episode 2 might completely change the way you see the market.